If you're a business owner and your tax plan is basically, we'll deal with it at filing time, this is the kind of law that can quietly cost you a lot of money. Hi, I'm Joe Stoy, financial advisor and senior accountant here at Base. The One Big Beautiful Bill rewards planning and penalizes ignoring the details. So let's talk about what actually changed and why it matters to your business. There's been a lot of headlines and opinions around this bill, but what matters most is how it affects your taxes, cash flow, and planning decisions going forward. So let's start with the biggest change. For the first time in a long time, many of the existing tax rules are now permanent. Before this bill, a lot of tax cuts were set to expire, which made planning difficult. Now the current individual tax brackets and key provisions are locked in. For business owners, especially those operating as LLCs, S-Corps, or sole proprietors, this creates stability. You can finally plan beyond just one tax year at a time. Now let's talk about new deductions, because this is where many people miss opportunities. If you earn income from tips or overtime, those amounts may now be deductible at the individual level. This is especially impactful for business owners and employees in industries like hospitality, service, healthcare, and construction. It doesn't eliminate payroll taxes, but it does reduce taxable income, which can lower your overall tax bill if it's structured correctly. Another area that matters is vehicle expenses. Under the new rules, car loan interest may be deductible in more situations than before. That means financing a vehicle rather than leasing or buying outright could make more sense depending on how the vehicle is titled and used. This is one of those areas where how you buy something matters just as much as what you buy. Now let's talk about state and local taxes, also known as SALT. The deduction cap was increased to $40,000 for certain income levels. For business owners in higher tax states, this is a meaningful change when paired with planning strategies like pass-through entity elections. This can result in significant savings, but only if it's done properly. There were also changes that impact families. The child tax credit was increased and made permanent, which helps with long-term personal planning and especially for business owners, balancing both business and household cash flow. But here's the most important thing I want everyone to remember. None of this works automatically. Just because these rules exist does not mean you'll benefit from them by default. Your entity structure, how you pay yourself, how income is reported, how expenses are documented, all of that determines whether these changes help you or not. Two business owners can make the same amount of money, run similar businesses, and still end up with wildly different tax outcomes, simply because one planned ahead and the other didn't. This bill rewards proactive planning, not last-minute tax filing. So this is a great time to reevaluate your business structure and review payroll compensation strategies. Look at deductions you may be missing and align your tax strategy with how your business is actually operating. If you're a business owner and you're unsure of how this bill affects you specifically, that's normal, but it's also your cue to ask questions now. Because the biggest mistake business owners make with laws like this is assuming it doesn't apply to them, when in reality, it absolutely does. This law didn't magically lower taxes for every business owner. It created opportunities for those who planned. Two businesses, again, can make the same money and pay very different taxes. The difference is understanding the rules and using them intentionally. If you want to know how this law affects your situation specifically, let's talk. Book a meeting with our team and we'll help you apply these rules the right way.